so we're on page 130, problem 26. On January 3rd, 2013, Persoff Corporation acquired all of the outstanding stock of Seacliff. So Persoff is the parent, Seacliff is a subsidiary, in exchange for $6 million in cash. So we can start with actually we're going to do our first two things first. Which method are they using? How many prior years, right? Then we've got that number for the DDES. They elected to exercise control as a wholly owned subsidiary with an independent accounting system, which simply means they are separately legally incorporated, but in accounting they are one accounting entity. So we need to consolidate with a worksheet. Both companies have December 31st fiscal year ends. At the date of acquisition, stockholders' equity was $2.5 million, including retained earnings of $1.7. So we've got our book value, $2.5 million. So far, so good. Just every problem a little bit different in its presentation. They pursued the acquisition in part, well, I don't know why they did it, who cares? So we've got a book value, fair value for patent, book value, fair value for computer software. So we've got two way undervalued. And then the remaining identifiable assets and liabilities had acquisition date book values that closely approximated fair values. In other words, there are no more specifically identifiable reasons for the excess. Since acquisition, no assets have been impaired, yay. During the next 3 years, they reported the following income and dividends. So Seacliff, we're going to do the T accounts to see what the investment balance looks like. December 31st, 2015, financial statements for each company appear below. Parentheses indicate credit balances, yay. Dividends declared were paid in the same period. Okay? So far, so good. We're going to, as we approach this, and I will do A, B, C, and D, but before we do, what method are they using? And how do you know? Are they using the initial value, also called the cost method? They are not. How do I know that? The investment is $7,165,000 at the end of 4 years, right? What would it have been under the initial value method? If they were using the cost or initial value method, it would have been the purchase price, $6 million, right? Under the cost, those two, it never changes. So I know it's not the cost method because the investment account has changed from the $6 million purchase price.
So what's the book value if the purchase price is $6 million? It's the $2.5 million?
$2.5 million is the book value. But we're not doing the DDES. The first thing we're going to try to figure out which method they're using because they don't tell us. We have to figure it out. We know it's either equity or partial equity now. Okay? If it were partial equity, since we own 100%, then the Persoff equity earnings would be equal to the net income of Seacliff. Is it? Do you see Seacliff's net income? How much is that? $975. How much is the earnings on the parent's books? $575, which tells me two things. It is the equity method, and it tells me the amortization is $300,000. So by the time I finish my DDES, I should have an annual $300,000 amortization. Pretty cool, ain't it? Yay. 4, 9, 5. Yeah, 4. I can't subtract today. Okay? So we know that we're using the equity method. Secondly, how many prior years are there?
No, wait, 2.
2. 2013 is a prior year. 2014 is a prior year. The current year is 2015. We have equity method, 2 prior years. Now we're ready for the DDES. Purchase price was $6 million. Book value on the date of acquisition, $2.5 million. Check my math, please. The excess is $3.5 million. And then we had 2 things that were undervalued. $2.1 million, am I right? million for the computer software. I just did subtraction. On bottom of page 130, 2.24 million minus 140,000, 1.26 million minus 60,000. Following? Okay. And so, am I right? 3.3 million? So goodwill is determined to be 200,000, 0.2 million. How we doing?
Wait,
Am I
where
wrong?
are you getting those numbers from again?
It's on the, you know how,
Bottom of page 130, asset patented technology 140,000, book value, fair value 2.24 million.
the difference between the fair value and book value?
It's undervalued.
On 26.
Oh,
It's up there.
You
okay.
found it?
Yeah, it was in that little thing up at the, and I was looking down on the bottom, like, where are these numbers coming from?
The patent has a 7-year life, so that would be $300,000 a year. The computer software, is that right? Yeah, the computer software has a 12-year life, is $100,000 a year, so our annual amortizations are $400,000, which we've already proved, haven't we? We already knew that, which is why the parent's earnings account is 100% of 975 minus the 400,000. You getting it? Isn't this cool? I know, I need to get a life. Okay, so we've got the DDES. We ready to do the journal entries? All right, well, let's see. Construct their acquisition date, fair value allocation schedule. Well, that would be the DDES, we did that. Show how they determine its equity earnings. We already did that. 975 minus 400 is 575, correct? Okay. Part C says show how that they determine the investment in C-Cliff balance. All right, let's do that. So the investment account on date of acquisition would be $6 million. And we have 3 years that we need to account for, right? So this was 1/1/13. That year it says they had net income of 900, dividends of 150, and then they have a $400,000 amortization. So at the end of that year, somebody can help me do all the math here. 940, 150.
6,350,000. That was mental math.
That would be 12/31/13, 12/31/14, 12/31/15. What's this number right here?
What, your net income?
No, investment balance, 12/31/14. This plus this minus this minus this. Because they don't do it the same as we do.
6740000.
6.74,
I think.
okay. And then in 2015, 975, 150, 400, and that should bring us to 7.165. Does that work? If not, I did something wrong somewhere. But every year, this is what we memorized from chapter 1. Up for net income, down for dividends, down for amortizations. Did it work?
Yeah.
Okay. This should. That was part C.
So since we made the investment one, does that mean we have to make the retained earning ones too, or? Like the investment
The
T,
investment earnings one?
or no, it's like, you know how we have like the investment like T account?
Yeah,
Does that
we can
mean-
do the earnings, investment income account. Is that the one you're talking about?
Yeah,
Yeah, and it would be, for this year, 975 and 400 is, actually, they're backwards,
that
sorry.
would be, wouldn't it be 150?
No, the 150, the other side of that was cash. 975 and 400 is 575. So that actually answers part B. This answers part B, this answers part C. The DDES answers part A. Eric, you lost?
Yeah.
Dividends are not in earnings. Because dividends are seen, in the equity method, dividends are not seen as a return on the investment, but a return of the investment.
But it
Debit, cash, credit, investment.
But if it was a retained earnings T account, you would
Yes.
use.
Yes, which is kind of what they did. They showed the change in, I don't like their schedule. Just use your T accounts like we've been doing all along, okay? We're going back and going back and going back to what we know. Don't try to do it in a new way. You'll forget something, you'll mess something up. Okay, now we're ready for our worksheet entries. Are we ready? So, the S, subsidiary stock, the source is the worksheet. And so, you're gonna debit common stock. Is there an APIC on the subsidiary? Sometimes there is, sometimes there's not. Subsidiary have an APIC? No, this one doesn't, okay? So it's retained earnings, but remember that it's retained earnings beginning of the year. So 800 and 3.240.
We're gonna have to memorize all these setup journal entries.
Uh-huh. Well, but you remember with this, it's called subsidiary stock, so you look for all the stockholders' equity. Yes, you need to memorize this. And the total of that is 4.040 million. Sorry, Charlie. No cheat sheet here.
Gosh, Casey, did you not expect that?
Well, at least I'm telling you how to do it.
So where'd you get
Yeah, that's true.
3.24?
It's the,
Beginning of the year.
Beginning
Look at the
of the-
retained earnings beginning of the year. It's
For
going to
the
be in the statement of
subsidiary.
retained
Oh,
earnings.
for the subsidiary?
yeah, so
It's
the
subsidiary.
secret.
You're eliminating the subsidiaries' stockholders' equity accounts. But it's not the 4.065, it's the 3.240.
Basically, the only thing that's
That's
parent,
a real common error.
basically the only thing that's parent entries in the setup is the credit or debit to investment account in the subsidiary.
Yep, yes. Everything else.
Because he credited it 3 times. and
Yeah, I never really
once.
thought about that, but I guess you're right.
Everything
Because
else.
we're trying to adjust or record these PNC and goodwill.
So this
Yeah.
was the S, right?
This is the S, subsidiary stockholders' equity
And then
account.
the investment is nothing, or is
Is
it?
the net.
Okay.
SAID, the plug is the investment account. The A, so that's S. The A, allocations to DDES, source is DDES, all right? So we're gonna debit patented technology and debit computer software. Now, this time, it's not the DDES number, it's the DDES as amortized to the beginning of the year. So we said, how many prior years are there?
2.
2. So 300 plus 300 is 600. Take that off of 2.1 million. 2.1 million minus 600,000 equals 1.5 million.
So I think I wrote this down, so before, for A, you do previous years, but for E, you do previous and current years.
E is just 1 year. E is always 1
So
year,
just current year.
just the current year. This is the 2 prior years, the E will be the current year. And we will then have all 3 years. So this is the 2.1 minus 2 years, the E will be minus 1 more year. Making sense now? Confused about it. The copyright, 1.2 million minus 2 prior years would make this 1 million. And the investment is 2.5 million. Yes? Questions so far? Oh, I forgot my goodwill again. I forgot my goodwill. Sorry. Goodwill, 200,000 is 2.7. Yep, 2.7. Sorry. I could say that it's not only the most common error, it's also my most common error because I do it every time.
So what happens if you forget it when we're taking the test?
I will not. I will not because I will have taken the test before you.
So if you don't get 100 on the test, do we automatically get those as part of like a curve, or is that just
I
in our,
usually get 100.
or is that just in our 20 points?
It may be part of a curve. Okay.
So we can get some points, and we just all leave.
All right, so now let's do the I. The I, this is subsidiaries, the I stands for investment income. Okay, thank you. Investment income from investee or investment income or whatever. Okay, so we go, the source is the worksheet. Find the parent's account that's got the investment income in it. What is it? It's gonna be on the income statement. Where is it? How much? Yeah, it's called equity earnings in C-Clip on this one. Find it, get rid of it. It's a credit, so we gotta debit it.
Where
You don't
do
see it? It's on the worksheet.
Yeah. Is it the investment in Sequel?
No, that's an
It's the-
asset. This is a revenue.
It's the equity
Okay.
earnings.
So that's the difference.
It's in the income statement.
Yeah, so that's the 575.
It is. So we're gonna debit earnings, 575, and credit investment, 575. Okay?
It's pretty easy.
Yes, and if you forget goodwill on your test problem, I'll just say goodwill. Ooh, ooh, ooh. Okay. All right, so the D is the dividends of the subsidiary. Where do you find those? In the statement of retained earnings. Middle section. Worksheet is the source, and it is 150. They are already a debit, so we have to credit that. So our debit is investment. Right? I'm going to squish it in here. I'm going to do the E. And that's our E.
We always do the opposite.
Exactly. Because those are expenses, so debit expenses. Unless it's overvalued.
So it'd be the 400,000 would be the depreciation expense.
Debit, this was patent, right?
Yeah.
So that would be an amortization expense, 300,000.
Mm-hmm.
Actually,
Well,
both of them are,
And
both of them are amortization, aren't they?
Yeah.
So 400,000, credit patent, credit computer software.
Would it matter if we say amortization or depreciation expense?
Not on your test, it doesn't matter to me. It's just an expense, it's a consolidation expense, I don't care. Yes, it would matter if we were gonna publish that financial statement, but it doesn't matter on your test. It will not affect your consolidated net income, consolidated expenses, it will not affect anything. So I don't care. All right, is there a P? Let's see. Payable, receivable,
Intercompany pay.
and it's always a debit to payable and a credit to receivable, and I don't believe we have one.
Debit to what?
Debit payable, decreasing it. Credit receivable, decreasing it.
No,
We will have one,
on this.
next worksheet that we do.
So
We'll do
for,
one in class.
so for S,
Somewhere else.
if there was an APIC, you would add that on there too, right? Or
If there was,
an APIC, would that go up there too?
yes,
or
it would be an S, yes. If the subsidiary has APIC, sometimes they do, sometimes they don't.
Okay.
Okay, so what I'm gonna do now is I'm gonna give you your answer, but let's put it on the worksheet together, okay? So you've got this, so you can, before you use a pen, you can double check and make sure that you're putting it on the
So for the
right
adjustments,
place.
so for the adjustments parts, you go over and then you add your adjustments, right?
We're gonna post our entries now,
Okay.
then we're gonna finish the worksheet.
So for, if it's like based on the letter, is it the debit part or is it the credit part? It does depend.
Here's our debits, here's our credits.
Oh, okay, okay, okay.
Okay, so what, the first thing is
Good thing you're
Debit.
Miss Jessie.
common stock and beginning retained earnings. Those are your S's, right?
Yeah.
I'm just posting it now to the columns. That's all I'm doing. I've done my entries, I'm posting them, and my credit is right here. My A, debit, 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 credit. My I, debit, credit. I want you to do this though, I want you to take the time, I want you to do this. The more you practice, the better you're gonna get. The D, credit, debit, oftentimes people want to do that one backwards. This is a debit, so that must be a credit. We are eliminating it. And your D will always be a debit in new investment. And then at that point, you've got 4 entries done, and you should try to see if your investment's gone to zero. 7.165 plus 150 minus those 3 numbers equals 0. The investment should be gone. And then the E, wherever you have an A, there's either no E or there's an E on the other side. E, opposite from the A's. The A's making it go up, so the E's making it go down. Or if the A makes it go down, the E makes it go back up.
So for the retained earnings on the first one, you just do the parent for consolidated?
Consolidated retained earnings is always just the parent.
Okay.
It is always just the parent. Because the parent owns a subsidiary. You're reporting to the parent's stockholders.
Okay.
So they don't really care what the
What, yeah,
subsidiaries
what's
retain.
yours?
Okay. So do you have your adjustments posted? The next thing you would do is you would flip them and make sure they balance. 7.865 before you go any further.
So you suggest putting in the entries and then starting at the top line and going, and then whenever you have to, then put down and then keep going and then put down and then.
Yep, we're doing it in the order I would recommend. Equity method, 2 prior years, DDES, do the entries. If you need to, do your T accounts.
Say it again, so you gotta find the method.
Method, prior years,
Okay.
DDES, sometimes the T accounts. Okay,
Entries.
consolidation entries,
And then
post them to,
post to the works.
post the worksheet,
And then finish.
foot everything, and then you're ready to extend.
What do you mean by foot everything again?
Add these up.
Oh, okay.
And add those up and make sure your debits equal your credits, because you could have put something on the wrong side. And if you're off, cut the difference in half and look for that one and see if it's in the wrong side, right? Because if I put my If I put this 150 over there, I'm $300,000 different. Right? And then 2.7 million, 2.72 plus 2.25, thank you, is 4.97. This plus this equals this. This plus this equals that. This plus this equals that. And that should have gone to 0, which it did. Because that's what the I does, is it wipes that out. It eliminates it. Because that 575 is this and the 400.
What's the I stand for again? It's,
Investment income. And then I don't do this across because this plus this does not equal that.
you gotta go down.
You go down and you take that and put her there.
Okay.
Okay? This plus this minus that equals that. Credit, credit, debit is a credit. Okay? You've already got that there because you put it there. So it doesn't foot across. This plus this minus this equals that. And then you foot down and take that number and put it down here. This plus this equals that. That's already at 0. 300 plus 45 plus a million minus 100, 1.245. This plus this minus that. This plus this is that. This,
So for the investment
and then
in
down.
the investment in C Cliff, it's gonna be the 7.165 million plus the 150 should equal all those.
Yeah. Debit plus debit minus credit, credit, credit. So now you put this down, and you know what? It's real easy to not add in the top one, because you start with a 0 here, and so a lot of people just add those. It's real easy to not get that cash. That's a very common error for some reason. And then this plus this equals that. This plus this minus this equals that, and you've already got that from above. Put it down, and your consolidated assets equals your consolidated liabilities and stars. Pretty cool, huh?
So can you, you know how like the first step is to find out what method it is, right? So,
So let's go back through that.
Sure.
If the investment balance has changed from the purchase price, it's not cost method, not cost or fair value or initial value, whatever
say
they
that
call
again,
it.
it's if the investment, what?
Well, and if it hasn't changed, it is the cost or fair value or initial value method, right?
The investment.
That's the first thing you look at, is the investment balance. In this case, we're at
160.
7.165, which is not 6 million.
Oh, okay.
It's not this number. If it was 6 million, they'd be using initial value.
So if that number is greater than
Or less, either, if it's just different. Because they could have net losses.
Okay.
And then you look at the earnings number. If it's equal to the subsidiary's net income, then it's partial equity. And we are going there next time. Okay, what do we do for, just a little more. One more entry, the star C.
One more what?
Entry. You did set up, and then you do star C. Converting the initial value method to equity, or converting the partial equity to equity.
Star C is
Star C.
5 more entries.
It's a conversion entry, it's one. But there's one computation for if it's initial value, and there's a different one for if it's just a computation, one entry. So you only have one more entry. And all stars are done before you start set up. Stars go first. Just like on in Broadway. That's it for me. You're doing well.